So when we take a look at this range from this high, a little more clear, this high right here, put it like this. All right, you see that high, right? Down to this low. You guys see the low?
Yes.
And you guys see the high.
Yes. Is there?
Yes, sir.
That sets a range, right? Drag that out. That's your price range. So this is where current price is at right now, right there. So this is the leg that I would say is called exposed. This is an exposed leg of price action. What's exposed? All the orders inside. So if this is where current price is at, it's looking inside of itself. It's looking back and inside of itself at these extreme areas where orders reside. So if this is where current price is at, then on this side, it's looking to, get to where those orders are, or even create new ones and go to where those are at, and then run out the outside. Does that make sense?
Yes.
So in this example, I'm going to show you it's an inside to outside. But here's where the current buy stops are. So you understand what we're doing here? The range is down. We're expecting more downside, but as of right now, the chart is cheap. You see how it just went below a low?
Yes.
So now it's taking sell stops that are located below the low, and it's reacting to them, and it's causing the market to run up after the buy stops now. So long term, we're thinking something like this. But short term, we're seeing, a move up into the range. This just ran outside of a low, so now it's coming back inside of the range. So if we're waiting for the sell side, we're going to wait for the buy stop area to get put into first, and then we're going to watch price at a certain time windows. And what we're going to watch for is a reaction, and then we're going to shoot for the lows to do a inside to outside move. So we have to anticipate more downside, but we have to actually see where are the buy stops that we could sell to for that idea to come through. You can actually see them this far in advance. I want you to take note of that. You can always know where you're going to trade. It makes complete logical sense. That causes you to limit the amount of trades you put on because they haven't entered an area that makes logical sense yet. So see, all of this, the little double top, the engulfing here, none of that will catch you. None of that, because you can see in the range you're cheap and you're not even where buy stops are. So you don't want to sell any of that. See, that's selling a gimmick versus selling to orders versus calculating price, counting the cost of the trade, seeing the value of your trade. So this is high valuation to low valuation. If you're selling down here, you're selling low in that price range. So here you're allowing price to come back to a high value to sell to and to an area that actually makes sense that you could sell to, where there's actually buy stops, which is above these little highs in here. Market here is building volume. Whenever you see the market stay tight in one area and spending time in an area, the more time it spends in an area, the more volume it has. So what I just said, time is volume when it comes to these charts. Time spent in an area is what shows you volume. More time spent, more volume. So you'll see a bigger, more volatile move to come out of it. So here you're seeing the market is getting ready to get expansive because it's tightening up. It's getting ready to throw a punch. That's what I love to see right before market movements, the market get tight. But look at where it's getting tight. See how the market got away from this cheap environment? It ran up and got above this little high right here.
Yes.
So it's dealing to buy stops. So I'm showing you that how the market behaves has to do a lot with where it's at. You have to focus more on the where rather than what it's doing. That causes you to be ahead of the market because you're anticipating behavior in certain environments before the market actually gets there. So here the market is now taking all the stops here that it loaded up. Remember, there's a lot of volume here, which means there's a lot of untapped stops here. So that's what the market is tapping into right now, right above here. It could take those or it could leave those behind. But what I do know right here is that it generated a stack here and it's taking it right now. So it took even this topmost one. And you can look now to attack the low. That's the target. See, now the market has pulled up inside of the range. This is a down range. It moved up inside the range. What did it do? It grabbed the orders that were there. You see? It's sold in here and it's sold up here. And now it's going to run out the sell stops that are waiting on the bottom. All the people who see this trend line forming, everybody buying on this side of the trend line is loading up the underside of it with sell stops. And that's exactly what the market wants. So everybody that's telling you to buy on this buy side of this trend line, they're teaching you to get your money taken with speed. That's what happens when you get trapped in like those trends.
I've been hurt like that plenty of times.
Oh, yeah. So at this, the market is already showing you a response to an area, and it has distance between it and its target. You can definitely sell right there if you want, or just sell literally any up movement that you can, or just start selling sell limits. You could target the low or a certain measure below. I'll just go for the 100 pips. So here I'm in. See what time this was. This was 9 o'clock, this up move. I got in at 8 o'clock. 8 o'clock's 1 hour candle. So see a certain time, I'm in a certain point in time now where I'm finally entering my trades. And it happens to be right when the market is dealing with these stops and is geared to expand out to those orders. It's because of a certain time. See, so time really narrowed down me having to sit through all of that. And price also narrowed it down because I didn't want to sell near that low. But what could happen, all of this movement, once you get really good at reading how to do these inside to outsides, you don't have to necessarily wait for the inside to complete to catch the outside. You can literally catch this little short-term move. You could catch everything the market has to offer. But for now, I'm teaching you how to go in line with the previous range. The range was down. It left the buy stops behind. This is where you wait to attack and position yourselves in these areas where there's buy stops with inside of that range. And this is where you target outside of the range. That's the whole point of this teaching. Sell here too. I just sold to an up candle. And then that's the price run we anticipated. It's running out everybody who's in buys in here. It's taking out all of the sell stops that's underneath here. So price ran out the lows. This area is officially the area that price is giving the opportunity to exit. Starting like when it hits that low. Because now it's in an area where you can tap out your orders with the sell stops there. So see, I bought out of my sell position in a certain environment. So see, my entry wasn't inside of an environment. It was inside of the previous down range, above a high at a certain time. And my exit was outside of the range. And that was pretty much it. It was just easier. It was just when it reached the outside. Because there was orders there available for me to pair up to get out of my sell orders. Any questions on that inside to outside move?
You explained it beautifully, even on how to execute it too.
So this would be your continuation move then, right?
This is an example of a continuation. But it really, man, it really depends. Like if you're seeing it at this magnitude, yes, that's a continuation. What I mean by that is because if you're seeing this low down here form underneath this low, and you're looking at these stops in here to go after, you're going to see a short-term reversal. There's a shift down here, and we'll get into that later. But there's a smaller magnitude movement higher before it did this overall flow down. See? So yeah, it's a continuation, but from here up, this was a short-term reversal up. And then there's like a reversal here that lines itself up for the continuation. So that we'll get into movement with these concepts, but I just want to show you like there's as a whole, yeah, this is a continuation as a whole, but there's a lot of things going on here, and you can take advantage of all of it.
Mm-hmm.
So let's see something real quick. Let's measure out the 50% and deeper for the price range. See if we could have filtered out some things. See this high I had marked off down here where I had the stops here. I didn't even have to have that referenced at all. Why?
That time it happened.
Look. Why don't I need to reference these buy stops here?
It's expensive.
Try again. It's cheap.
Yeah.
So if I wanted to be a seller, I don't really care. I don't really have to even keep track of these because yeah, they're buy stops. Yeah, you could sell to them. Sure, you might see a reaction. But the thing is those are cheap. You don't want to sell cheap. You want to sell expensive. So automatically that just puts you right here, just right off rip. Those are the only expensive buy stops I see inside of this range objectively, is it not?
It is.
So I can literally wait. I could wait through all of this knowing that I'm just going to deal when it gets here. Isn't that crazy?
Yeah.
So that's when you add the tool, the measuring the range. That's what happens. You can actually measure the value. That's what you're actually doing. See, a range is a price range, a range of prices. What is price? It's the value we give to something. So what is it that we're giving a value to? We're actually we're giving the value to these stops. That these stops are worth this much, whereas these stops are worth this much. I would rather sell to these stops up here. These buyers are willing to buy at a higher price than these buyers. So I want to pair up with them. I want to sell to them. That's just how my brain thinks. So I can ignore all of this. None of that phases me. None of this phases me. In fact, this helps. I like this. These are expensive. See, so when it gets up in here, maybe I'll show you guys another HPE today. Right here, this is a HPE. When the market, you see how it's 2 o'clock right here? This is a 2 o'clock open, but a 3 o'clock close. So this is the candle from 2 to 3 o'clock. Do you see how that closing price came in at 3 o'clock? Opening at 2, but closing at 3 o'clock, yeah?
Yes.
That time window is very good for markets. They really expand out. So it's 3 o'clock closure. It's a, what kind of candle is it?
Up.
And what environment did it close in?
Expensive.
Buy stops. Extremes.
So it's on buy stop. It's in an extreme. It's above a high, and it's in an expensive part of the price range. It got a kind of a lot of things going for it, right?
Yes.
This selling to a up candle in an extreme for a sell is a HPE. This, bro, if you get used to selling like this, you will always have the best entries, and everybody will look at you like, how are you doing that? But it's because of the install program. If you, that's what we're doing right now. I'm installing this move 100% correct into your mind right now. This is what the best sells look like before they actually turn down. They look like they're moving up. They look like they're breaking a high. They look like an up close candle. But look at the conditions. Expensive price range, above a high, logic, there's buy stops, up close candle. So I will always teach you to sell up candles because they close near what?
Highs.
They close near the high of that range. Aren't you supposed to sell high?
Yes.
So if I were to sell a down candle, like the industry teaches, where does the down candle close near?
Cheaper pricing. The low.
The low of that range. So it's like, that doesn't make sense. So I always sell near the high. So this is what it looks like. Check this out. And what I'm doing is I'm anticipating a reaction. Before a down move, there's always an up move. Haven't you noticed that? Look, up move, down move. So I'm anticipating the drop by selling to the up candles. See? That's what that would look like. That's how I always catch the heads. And then anything after that head forms, I'm selling to all the up candles that form after that. Because at that point, the market has already turned. It's already grabbed what it's reached for. So now all I'm going to do is sell to up candles while I'm expensive before it drops down into cheaper environments and does the price run to get outside of the range here. What kind of candle is that?
Up.
That's my sell. You see, but it's an up candle in an expensive part of the price range after the market shifted, which is the other HPE. But I have to teach you guys shifts, but I just wanted to show you guys that.
Okay.
The point is to sell to the up candles in a certain environment. What kind of candle is this?
Up.
I'm in drawdown. Who cares? You're in a good price. You see, you're not looking for perfection. You're looking for the range of price. Reaction. You're anticipating that. You're still in an expensive part too. Now the price is cheap again, in the range at least. So look at where my sells are positioned. Expensive, above highs, to up candles. What am I anticipating? The stretch out to the outside part of the range. That up candle I could have sold. I just kind of clicked too fast. But it's an up close candle in the expensive part of the price range before the drop. That could have been a good sell. Just like that. This one could be, but it's just not closing on above here like I wanted to. That being stingy like that can sometimes cost you trades. You can get in there if you want, but I like for them to close up in certain environments.
Right.
That's just a personal preference, but you can catch literally all of these because you're still in line with the flow. I just like my orders to look a certain way, like very tip top, you know, that's all. But all these up candles, this one, this one, this one, this one, you could technically sell to as it makes its way to its target. Get used to seeing that. The market gives permission to get out and profit by being in an extreme. That's permission. So that's what it looks like. So I just showed you how I used the range to narrow down where to look to automatically. Like even from down here, I could see I wanted to trade up here. And look at where all my sells are. Since the market was down here, I was able to tell you where all my sells were going to be in that green box. Isn't that crazy?
It's crazy.
Beautiful.
And that all correlated to a certain time of day. And let's look for the open price of that day, which is the 27th. Here's the open price of that daily candle right here. So that day closed kind of compressed, but the next day is the follow through movement. So, but look, all of those sell that day set me up to put my sells on the high of that day up here. And then the following day gave me the price run. See, here's where the frame closes right here. And that was a Tuesday. A Tuesday candle made the high of this price run. Range theory good? You guys understand that?
It's great.
That's
Sure.
kind of crazy. I just went over the same range again.
Yeah, that was solid.
Just a little more, just a little different. Did you guys pick up anything different on the second time I went over this same price range than the first time, or was it just a repetition for you?
There was and a thought was expanded upon. Like when you said time equals volume, and the more time spent in that area means is like there's more volume. And something else that was like really, really stood out to me this time around going over it was I paraphrased it. It was like time and price will narrow down my activity, and I'll be more selective on what and where and when I get involved in the markets.
Yeah.
Yeah.
Yep. Anybody else?
I think that's spot on what he just said.
Yeah, being selective, man. Like that's really what it is. You can only be selective if you know what you're waiting for. You can't be selective if like that's why you used to sell double tops and buy double bottoms. You had no selectivity to it. You took anything that was offered. But now you're going for the right things. You're being selective. You're not just going to take anything. You're going to take what makes sense.
Yeah.
I think also showing it the second time you kind of qualified your 8 PEs, because there's some you could have adhered to, it still would have resulted in good pricing, but it wouldn't have just given you the most optimal pricing. So for example, this taking the pricing above here, utilizing the emerging data, technically it still makes sense on some HPEs, but there was optimal HPE that was available right there as well that you could take advantage of. So even qualifying your HPEs and which ones you're going to adhere to can.
But look, even blending them though, because you got the time of day situation.
Yeah.
Because this was at 2 o'clock, 3 o'clock. This was a little too early. It wasn't a good spot in price, but not in time.
Yeah.
This wasn't a good spot in price and time. Time confirms price levels.
Nice little combo.
Oh yeah. And that's a powerful thing to write down. Time is principle, like it's preeminent. Time takes the cake. Like without time, you don't got nothing. Time confirms price. Your confirmation is actually the time that you place your trades. But you're always trading orders, so everything always makes sense. But what really confirms it is what time you place it, because that's when the engines uncoil, the chart printer, basically. It uncoils. So if you're purchasing orders or selling orders above or below the day's open price at a certain time, it's because of the time that really puts you in at the you know, the optimal place. It's really the time. Any comments, questions, concerns? I might do a part 3, but not right now, just because I need to show you guys more examples. I really wanted to get a lot of range teaching in this one, just so that when I do show you guys a lot of examples, you can see them clear as day.
Yeah.
Yeah, this is, yeah.
Like, I don't know if you see this one. Hold on, because this is just too clean. I gotta take a picture of it. Okay. See, you did the same exact thing. The same exact play, yo. It did the same exact thing inside to outside. It's just how you read it, you know? Are you able to read that? Are you able to see that? From this high to this low. Downrange. Every extreme above that has buy stops. These are the expensive ones. Look at where price ran to. And then look at the time that they formed. Too early or too late, too early. These were right on time and they were right on price. You can get in there, you can get in there, you can get in there. You can get out here. That is range theory part 2. Peace out.